Okay, good evening, guys. Good evening, dear students. Apologies for some technical issue at our end. So, right now we are good to begin with the session. Anyways, how are we all? We all good? Everyone? Okay, so let's get started with the next topic in our interesting subject of financial management. Uh, in the yesterday's session, we had discussed about various sources of finance, scope and objectives, right? And in today's session, we'll be actually discussing about the various uh, ratios or numbers to analyze the financial health of a company. Okay. So when we, before we go to this particular subject, uh, if we want to analyze any financial health of any company, or let's say you want to invest, okay, suppose you want to invest 1 crore in certain companies. So you want to invest 1 crore in companies. Let's say you want to create a portfolio of 10 different companies. Okay. So how do you decide which should be these companies? How do you decide which companies should be these companies? Yeah. On what parameters are you going to decide which are these companies? How are you going to take a decision about yeah. Okay, so you look at EPS. Okay, any other numbers or any other ways of looking at how do you decide which company is to be chosen based on the profitability? Okay, so the parameters that I can make out from the things, you look at the profitability. Then any other criteria? Segment performance. Okay, you could be looking at what is the amount of debt or what is the amount of borrowings a company has. Right? So looking at what is the amount of debt that the company has taken, right? So profitability, you may look at the leverage aspect, or instead I can say, uh, debt, the level of debt that the company has. Okay, you're going to look at certain P ratios. Okay. Okay, so you'll be like looking at various financial parameters before we take a call which of the companies are to be chosen for investment purpose. Right. So we're going to look at various parameters based on which we're going to decide which companies, which of the companies should be chosen. Right. So profitability, debt ratio, the price to earning ratio, many such different ratios are many different ratios are going to be there in our discussion. Now, when we're looking at these parameters, we are essentially trying to understand what is the financial health of a company, right? So financial health is going to be calculated, is going to be measured by way of certain ratios. It's going to be calculated, it's going to be measured by way of certain ratios. Now those ratios, or it could be also in terms of some percentages. Okay. So now the question is, how are we going to analyze these ratios? So we are going to segment the ratios into multiple categories. Various numbers we are going to calculate. But let's try to not just remember or just just mug up those formula. Rather, we are going to discuss those formula with their logical sense. Okay. So let's just get started with that discussion with initial few ratios. Probably today we'll be just doing the ratios. Even in the next session, we'll be doing half of the session in the next class will be for understanding the ratios, and the Next half will be for understanding the, what we say as, next half will be for understanding the questions that we'll be discussing. Okay. So let us say we have got two companies, A and B. Okay, so I've got two companies, A and B. Company A is having some amount of current asset. So A is having a current asset of, let's say, 1 lakh rupees. B is having a current asset of 10 lakh rupees. Now, out of these two companies, which one do you think is more liquid, or which one of these two companies do you feel is having a greater degree of liquidity? It means which of these two companies are more capable of honoring their current liabilities? Which of these two companies do you feel is capable of honoring their current liabilities? Company A or B? A is having a current asset of 1 lakh, B is having current assets of 10 lakh. Which of these companies do you feel are capable of honoring the obligations of the current liabilities? Yeah. Company B, well, we can't actually decide which of these two companies are better, guys, because we don't know against this current asset how much is the amount of current liability. Right? Against this current asset, how much is the value of current liability? That is something which we are not aware of. So let me just give you an information about current liability. Okay. Now, current liability for A, is, let's say, 50,000, and current liability for B is 9,50,000, and the net current asset, it works out to be like 50,000, and here also it is 50,000. Now tell me, which of these two companies do you feel are more capable of paying their liabilities, or more capable of paying their current liabilities? Because net current assets is same for both of them. Net current assets is same, which is 50,000. Right? So net current asset is same, 50,000. Now, which of these two companies are more capable? Can I look at just the net current asset and decide which of the two companies are less capable or more capable? Absolutely not. Rather, if I tell you something like this, suppose there is another company C, okay, with a current asset of 1 crore and current liability of 99 lakh 50,000. There still you're having a net current asset of 50,000. Now, we cannot say that all three companies are having the same degree of liquidity. We cannot say that all three companies are having the same degree of liquidity, right? Why can't we say so? Because the simple thing is, it's a net figure, or this net working capital, nothing but it's net current asset is something the working capital, right? So I cannot say that all three companies are same. Rather, we should be calculating something called as current ratio. We should calculate current ratio to decide which of the companies are more capable. So current ratio is going to be calculated as current asset upon current liabilities. Current ratio is going to be calculated as current asset upon current liabilities. Okay. So now current asset upon current liabilities, when we compute, what about company A? Current ratio, can I say it is 2? For company B, it is 1.05. And for company C, it is 1.005. So if I want you to analyze, how do we analyze this number 2? This number 2 in form of current ratio, it indicates for every rupee 1 of current liability, the company has rupees 2 of current asset. For every 1 rupee of current liability, the company has 2 rupees of current asset, right? And same way, here it is like for every 1 rupee of current liability, the company has rupees 1.05 of current asset. Now, obvious thing is, out of these two companies, A and B, which one do you feel is more capable of honoring its obligation? Which one do you feel is more capable of paying the current liabilities? Obviously, company A, right? Why do we say so that it's company A? Why do we say that it's company A? Because company A is having current asset which is double that of current liability. I mean, what you have to pay and what you have is a simple relation between them. You have 2 rupees to pay 1 rupees. On the other hand, company B has got 1.05, right? Company B has got 1.05 for every 1 rupee of the current liability. So the coverage, the number of amount of current asset is definitely higher in case of company A, and therefore we say company A is a better term, right? So what should be the rule for current ratio? Current ratio, can I say higher current ratio indicates higher short-term liquidity. So a higher current ratio is going to indicate a higher short-term liquidity. So if your current ratio is high, it is going to simply indicate a higher degree of short-term liquidity. Am I right, guys? Are we getting it? Yes. So if we have another company which has got a current ratio of, let's say 5. If you have another company which has got a current ratio of 5, is it more liquid or is it more solvent than company A or not? Yes or no? Is it more liquid? If there is company D which has got a current ratio of 5, is it more liquid and more solvent than company A? Of course, yes. But what if this current ratio is very high? Suppose the current ratio is very high, which is 10. So 10 means we're talking of for every rupee 1 of current liability, the company has rupees 10 of current asset. So it's like you're having a very safe degree of current ratio. You have a very safe solvent ratio, and right, solvent or what we say liquidity ratio. But do you see any problem if, let's say, 1 rupee of current liability and you have got a current asset of 10? Do you think of any problem that can have? Do you think of any problem if a very high current ratio is there, let's say 10, which means for every 1 rupee of current liability, you've got 10 rupees of current assets. Do you think any problem is there? Yes, there is a problem. Yes, there is a problem. The problem is very high current ratio indicates inefficiencies. Indicates inefficiencies. 1 second. Take this call. Okay, sorry guys. Yeah. So very high current ratio is going to indicate inefficiencies. So very high current ratios is going to indicate inefficiencies. Now, inefficiencies in what sense? See, if you have very high current ratio, what does that indicate? Very high current ratios, what does that indicate? Maybe your level of stock is high. Maybe the value of your debtors is high, right? So very high current ratio would mean the level of stock is very high, or the level of debtors is very high, or maybe you're having a very high level of cash. Okay. So if you're going to have a high level of stock, what would that mean? If you're having a very high level of stock, what would that mean? If the level of stock is very high, what would that mean? Can I say you are inefficient in the way of selling? Right? So you're having like selling inefficiency. Right? So there are selling inefficiencies and not able to sell your product. Then debtors, when your debtors are also high, what does that mean? If the debtors are also high, what does that mean? Can I say you are facing collection inefficiency? Right? So there is collection inefficiency. What if your cash level is high? If your cash level is very high, what does that mean? You are not able to find proper investment opportunity. So investment inefficiency is something that you are facing, right? So very high current ratio, it indicates inefficiency. So sir, we should have high current ratio, but we should not have very high current ratio also. So if you're saying that you can have high current ratio and very high current ratio, then what should be the ideal current ratio then? What will be the ideal current ratio? Yeah. What is the amount of idle current ratio? Well, idle current ratio is 2. It means for every 1 rupee of current liability, there should be 2 rupee of current asset. Okay. So in a nutshell, we can say current ratio is current asset upon current liability. Current ratio will be current asset upon current liability. Okay. Now, let's go ahead with the next sort of discussion. Suppose a company maintains a current ratio of 2:1. Suppose a company maintains a current ratio of 2:1. Okay. So in current assets, let's say the company is having stock, or let's say the company is having cash balance, bank balance, then you have short-term investments, cash balance, bank balance, short-term investments. Then let's say you have receivables. Then cash, bank, short-term investment, receivables, and let's say I've got stock, and you have prepaid expenses. Okay, so cash balance is, let's say, 10,000. In bank, you have 20,000. Short-term investments, you have got 40,000. You've got 1 lakh of receivables. Stock is worth 3 lakh. Okay, and prepaid expense is, let's say, 1 lakh. So what is the total of current assets, guys? What is the total of current assets? What is the total of current assets? If you add up all the current assets, how much does it total up to? Can you give me the total? 5,78,000. How come 5,78,000? No. 5 lakh, 5,80,000. No, Baba. Like 10, 20, 30, 70. 5,70,000, right? 5,70,000. Correct? 10, 20, 40, which is 70, and then this was 570. Okay. Now against that, suppose we have creditor. In the creditor, we have got 2,85,000. 2,85,000. It's, let's say creditor is 2,85,000. Yeah. So now current liability is 2,85,000 and current asset is 5,70,000. So what is the current ratio over here? What is the amount of current ratio over here? Current ratio 2. So can I say this is an ideal situation? This is an ideal situation. Current ratio of 2. So the current ratio of 2 is a typical ideal situation, right? Now suppose these creditors ask for money. Creditor 2,85,000. They ask for money now. Okay, so creditors 2,85,000. We have creditors, let's say 2,85,000. They come and ask for the money. How can I make them payment? Of course, to the creditors, I'll be first making payment by way of cash to the tune of 10,000, and then make payment by way of bank transfer, maybe the 20,000 amount. Right? We may sell off the short-term investments and make the payment. So short-term investments would be like 40,000 being paid out to them. Okay, so what is left out now? Suppose we go to the, total out of 2,85,000, we just paid 70,000. We still have to pay a lot of other amount. So now we still have to pay 2,15,000. So suppose I go back to the receivables and ask them to give me a, let's say a bill receivable. I ask them to give me a bill receivable, and I take that bill receivable and get it discounted, and receivables, let's say 1 lakh is the receivables amount, and out of that we are going to deduct some percentage from the receivables. We are going to deduct some percentage towards the amount of deduction, towards the amount of receipt. We are going to deduct certain percent towards bank charges, and maybe out of 1 lakh we are able to realize 98,000, which is obtained by way of bill receivable discounted. So the total that we have after all this payment is how much? 10,000 minus 20,000 minus 40,000 minus 98,000. We still have 1,17,000 to pay. Now, how should I pay this balance? Yeah. So 1,17,000 is the balance. Now, how should I make this payment? Now, if you're going to sell the stock and look for making payment, that's not possible, because if you sell the stock, it will again go back to the receivables. Receivables will, it's not sure that you'll be able to sell the stock. So selling the stock is it's a bit challenging thing, right? Selling the stock is going to be a bit of challenging part, and therefore, we can say that the stock of 3 lakh, it can be sold, and we are not sure whether we'll be able to realize the money immediately. So this stock is basically sticky in your balance sheet, whereas it's going to be there unless and until you're going to sell it. Similarly, I can't use this prepaid expense to make my creditors claim, right? So we can get a loan by pledging, but then directly it's not easy for us to, take, make payment by using this stock or prepaid expense. And therefore, we can say, in spite of having the current ratio of 2, we may face a situation that we are not able to honor the current liabilities. We may face a situation that we are not able to honor the current liabilities, and due to that, we can say, as the current ratio is 2, we're not able to honor the current liabilities. And as the current liabilities can't be honored, this is something that we need to improve this ratio. So how do we improve this ratio? We can simply improve the ratio by removing these 2 items from our ratio, because these 2 items are actually not useful to make immediate payment to the creditors. These 2 items are not immediately available for making payment to the creditors. So I need to revise this ratio as liquid ratio, or we call it as quick ratio, or we also call it as acid test ratio. We call this as liquid ratio, quick ratio, or acid test ratio. How are we going to revise this particular ratio? We'll be, instead of taking full current assets in the numerator, we will be considering only those current assets which can be used to make payment to the creditors. So from current assets, we are going to subtract stock and the prepaid expenses, right? And then divide it by current line. So liquid ratio, quick ratio, or acid test ratio can be obtained as current asset minus stock minus prepaid expenses upon current liabilities. Right, guys? So we are getting these modified ratios as current asset minus stock minus prepaid expenses upon the current liabilities. Okay. Fine. Well, we haven't subtracted the receivables over here, right? We haven't subtracted the receivables over here. So we can make this ratio a bit more strict by saying that only these 3 assets are essentially available for quick payment to the creditors. We can get monetized. We can monetize the receivables also by converting it to bills receivable and then getting it discounted. But again, it takes time and it's a procedural part. So to make it even more better, we can actually calculate absolute liquid ratio. Absolute liquid ratio. This can be calculated as, instead of subtracting stock and prepaid expenses, what we can do is, for absolute liquid ratio, we can just consider in the numerator cash, bank, and short-term or marketable securities or short-term investments, and then divide it by current liability. So this is an even more strict or a better version of the liquid ratio, right? So in terms of liquid ratio, for a liquid ratio, we can say it can be a current ratio, which will be current asset upon current liabilities, or liquid ratio, which will be current asset minus stock minus prepaid expense upon current liability, or absolute liquid ratio, which will be cash plus bank plus short-term investments upon current liabilities. Okay. Right. So these are the short-term liquidity ratios. Apart from this short-term liquidity ratios, we can actually have some more additional liquidity sort of ratios. Let us just discuss about those ratios. Okay. One second, guys. Okay. So in this liquidity ratio, we have covered three things: current ratio, liquid ratio, absolute liquid ratio. Current ratio may not be sufficient, as we have discussed, that in spite of having a ratio of 2:1, we may face a situation that payment may not be made available to the creditors. So we just thought, let's go for liquid ratio and then absolute liquid ratio. Okay, absolute liquid ratio is, by the way, also called as cash ratio. Okay. Now, apart from this, we would like to also know, with regards to the liquidity part also, we would like to check whether we have sufficient quick assets to meet the day-to-day expense. So I'm going to look at how to check if we have sufficient quick assets, to meet day-to-day expenses. So how are we going to check whether we have sufficient quick assets to meet the day-to-day expenses? How are we going to check that? Right. So for that, let me just take you an example. Let's say there is one Mr. A and another is Mr. B. Mr. A is having a cash balance of 10,000. Mr. B is having a cash balance of, let's say, 6,000. And their daily expense, Mr. A is having a daily expense of 500, whereas Mr. B is having a daily expense of 400. Okay. So now if I ask you, out of these two persons, out of these two people, who is having a cash balance for a longer tenure, or cash balance sufficient for a longer tenure? A, I just put it other way around. For example, just A, just look at Mr. A. The cash balance that Mr. A is having, that is sufficient for how many days? The cash balance which Mr. A is having, that is sufficient for how many days of expense? Can I say 20 days? It's 20 days, right? Correct. So cash balance which the Mr. A is having, that is sufficient for 20 days. What about Mr. B? Can I say 15 days, right? So I can say days of cash available, we can say it is 20, and here it is 15 days. Now, if you just look at Mr. A, we will say that Mr. A is having cash equal to 20 days of expense, whereas Mr. B is having cash equal to 15 days of expense. Mr. A is having cash equal to 20 days of expenditure. Mr. B is having cash equal to 15 days of expenditure. So out of these two, Mr. A and B, 20 days of expenditure, and here it is 15 days of expenditure. What is the best way? I mean, which one is having a more buffer days? Of course, it's Mr. A, right? So the more number of days of cash you have, the better is your situation, or the better is your liquidity, right? So this, to check if we have sufficient quick assets, or not, we can simply calculate something called as basic defense interval. So we're going to look at something called as basic defense interval. Now, basic defense interval is, it is going to tell us how many days of quick assets are available. So it's going to tell us how many days of quick assets are available. Now, just as we did this 20 and 15, can you just tell me, how did you compute this 20? How did we compute this 20? How did we compute this 20? Can I say 10,000 upon 500? And what is 10,000? What is 500? 10,000 was cash balance available. 500 was daily expense, right? Similar formula is going to be there even for basic defense interval ratio. So for basic defense interval ratio, we need to have like cash plus bank balance plus marketable securities plus receivables. We are going to include receivables in our books of in our calculation also, because by the time we need to pay the expense in future, we would have collected that receivable amount. And then this divided by daily operating expense. And remember, the answer over here is going to be in number of days. Basic defense interval is going to be in certain number of days, right? So basic defense interval is going to be by certain number of days. Now, the question is, how do we compute this daily operating expense? Can you think of how do we compute the daily operating expense? Well, this daily operating expense number can be computed as cost of goods sold plus admin and general expenses, right? Plus selling expenses. And from that, further we are going to subtract depreciation and amortization. So COGS plus admin and general expense plus selling expense minus depreciation and amortization, the whole divided by number of days in a year. So COGS plus selling expense plus general expense minus depreciation and amortization divided by the number of days in a year. Okay, so that is how we compute the daily operating expense. Now, of course, why are we removing depreciation and amortization? Because it's a non-cash expense. You don't pay it in cash, right? And therefore, we are eliminating that. The rest all expenses are ultimately indicated. Now, what could be the rule for this basic defense interval, guys? What rule can we really set for the basic defense interval? Higher basic defense interval will indicate better capability to handle expenses, or less capability to handle expense. I mean, what will be the rule? Higher the better or lower the better? Higher the better or lower the better? Of course, higher the better it is, right? So number of days is 365 according to the, it's generally we take it as 365 unless and until the question says that assume 360 days or 250 days or whatever it is. So generally we say it's like the number of days is going to be 365. 365, 366, right? Yeah. But yes, you can also say that if the basic difference interval is very high, if it is very high, it can also indicate that company is building up cash for some purpose. Maybe the company is having a high level of cash, or it is building high level of cash for the payment of, maybe for the payment of capital expenditure, maybe for the payment of dividend, maybe for taking up new project. It is quite possible, right? So such disturbances, such deviations need to be evaluated further as to what are the reasons for these deviations. Okay, that's how we compute the basic defense interval ratio in the short-term category. Now, I hope we are clear with all the four ratios that you have done: current ratio, quick ratio, asset, and then absolute quick ratio or cash ratio, and then basic defense interval ratio. Okay. Tell me, what is current ratio? How do we calculate current ratio? How do we calculate current ratio? Current asset upon current liabilities. How do we calculate the quick ratio? How do we calculate the quick ratio? Yeah, quick assets upon current liability. What is included in quick assets? How do you compute the quick asset? It's going to be current asset minus stock and prepaid expenses. And then you have the absolute liquid ratio. Now that absolute liquid ratio will be cash and marketable securities and bank upon the current liabilities. And then we had the basic defense interval ratio, wherein we had all the quick assets in the numerator and denominator was daily operating expense. The daily operating expense was computed as COGS plus admin expense plus selling expense and minus depreciation and amortization expense. Okay. Now, let me just put up in front of you a case. We have got companies X, Y, and Z. Let's look at the balance sheet, the summarized balance sheet of those companies. One is the owned funds. Now, owned funds will obviously comprise of equity share capital and reserves, because these are the funds which are funded by the owners. And then you have borrowed funds. So borrowed funds, let's say company X is having 10 lakh of own funds, no borrowed funds. So total funds is 10 lakh. Y, it is 5 lakh and borrowed funds is also 5 lakh. Total is 10 lakh. Company Z is having, let's say, owned funds of 10 lakh, 2 lakh and borrowed funds of 8 lakh. The total is 10 lakh. Okay. And of course, the total assets that we have, that still continue to be 10 lakh. Total assets that we have is still 10 lakhs. So now tell me, out of these three companies, which one do you feel is more stable in long run? Which one do you feel is more stable in long run? When I say stable, it means the risk is lesser in a long run. Yeah. Company X, why do you say that? Why do you say that company X is more stable in long run? So there's no obligation, right? There's no borrowed funds. Am I right? There's no borrowed funds applicable here. And as there is no borrowed funds, can I say company X seems to be more stable? So let me just calculate few ratios to understand out of these three companies which one is more stable. So the first ratio that we're computing is equity ratio. Right? Equity ratio is also said to be proprietary ratio. Right? So proprietary ratio, equity ratio is also said to be the proprietary ratio. Well, this proprietary ratio is calculated as the amount of owned funds upon total assets. Owned funds upon total assets. So if we calculate the ratios over here for all the three companies, can you tell me what is the equity ratio going to be for X, Y, and Z? What is the amount of equity ratio for X, Y, and Z? Okay. Yeah, is going to be 1. And in case of Y, it is 0.5. And in case of Z, it is 0.2. Right? So this equity ratio, it tells us what proportion of the equity ratio tells us what proportion of this equity ratio is telling us what proportion of assets are funded by owners. So we want to know what proportion of assets are funded by owners. That's the equity ratio. Okay, so equity ratio is telling us what proportion of assets are funded by owners. Now, obviously, this equity ratio, is it higher the better or is it lower the better? There's no better term, but we can say higher the equity ratio, safer is the company. Right? Safer is the company because the risk in that company is relatively lower. Okay. Now the next ratio that we have, it's again going to be a complementary of equity ratio, which is debt ratio. Well, debt ratio is going to tell us borrowed funds upon total assets. So when we say borrowed funds, remember, borrowed funds will include both long-term and short-term funds. So both, borrowed funds is going to include both long-term debt as well as short-term debt. So borrowed funds will be both long-term debt and short-term debt. So in our example, the borrowed fund, debt ratio is 0, 0.5 and 0.8. So this ratio is indicating us what proportion of assets are funded by borrowed funds. What proportion of assets are funded by borrowed funds? Now, what would be the rule for this? Higher the better or lower the better? Lower the better, right? So here you can say lower debt ratio indicates higher safety. Okay. Then next one, we were looking at equity and debt with regards to the total assets that you have got. Now we are looking at, let's say, the relative comparison between both, which is debt equity. So debt equity ratio, there is no ideal number for these ratios, right? Because that will differ from company to company and that will differ from even one industry to another industry, right? This ratios has to be used along with some other ratios, which we will learn it in the due in a while. So let us say debt equity ratio. So debt equity ratio is simply, as the name says, debt equity ratio. it will be debt, which will include both short term and long term, divided by equity. Now, equity means equity share capital plus reserves minus any fictitious assets. Do we understand what is a fictitious asset? Do we understand what is fictitious asset? What is fictitious asset? What do you mean by fictitious assets? What do you understand by fictitious asset? Fictitious asset is basically those assets which are stated at advertisement expenditure, preliminary expenses, deferred expenses, all those expenses which we have not charged to the P&L, which we have not booked as expense, but we are carrying that as an asset. Right? So that is actually not an asset because it's a debit balance. But when you show such fictitious assets in your balance sheet, it's a wrong representation. So ideally, those fictitious assets should have been charged to the P&L and expensed. Right? But if that is not done, then it remains as a fictitious asset, and that is what we need to remove from here. Right? So whenever we say equity or owned funds, in fact, owned funds also include the same thing. Rather, owned funds will include your preference share capital also. Okay, so this is going to be like, in our example, debt equity over here it is 0, here it is 1, and then when we take debt equity over here, 8 lakh upon 2 lakh, which is 4. So this debt equity ratio gives an understanding as for every 1 rupee, for every 1 rupee of current liability, so for every 1 rupee of equity, which is owned funds, company has a debt of rupees X. Now, what can you say about this ratio? Is it high? Right? So in this case, it is going to be lower the sector. Right? So if you just put up other way around, equity ratio, debt ratio, debt equity ratio. Risk point of view. Higher equity ratio means lesser risk and safety or solvency is higher. Debt ratio, a higher debt ratio will mean lower risk. A higher debt ratio means lower risk. No, a higher debt ratio means higher risk and lesser degree of safety. Higher debt equity ratio means greater degree of risk and lesser degree of safety. Are we able to understand these three ratios in a comparative way? Everyone? Yes? DI, it's debt equity. This debt equity ratio, Sumit. Yeah? Everyone? Yep. Okay. Now, let's try to prepare an income statement for our analysis purpose, after which we'll take a break and then we'll go for the next long-term solvency ratio. So let's say our income statement start with sales, right? So we have sales. From that you reduce the variable cost. When you subtract only the variable cost, you have something called as contribution. Sales less variable cost is going to make it a contribution. Just like sales minus COGS gives you gross profit, same way when you subtract only the variable expense, then you get contribution. From contribution, we subtract the fixed cost to arrive at earnings before interest and tax. Right? So that will give you earnings before interest and taxes. Because remember, in this entire portion, we have taken only all operating things. Right? We have just deducted the operating part. From this EBIT, we subtract interest and then we arrive at profit before tax. Right? From profit before tax, you subtract the tax to arrive at profit after tax. From profit after tax, you subtract the preference dividend to arrive at net profit for equity shareholder. Right? Now, whatever is happening beyond EBIT, that is actually the financing part. So a business entity can be understood from two aspects. One is how it has been into the operations, how it is into the operations, and how it is into the financing part. Right? So how it is into the operations and how it is into the financing part. Into the operations, we can say it is up to the EBIT. Beyond EBIT, whatever numbers you see, that is because of how you have funded. Like if you have taken a loan for your business, you'll be paying interest. If you have issued preference share, you'll be subtracting the preference dividend from here. Right? So we can say these are the two parts of financing that we have, or the two parts, the ways in which business is being operated, business is being done. One is the operation aspect, another is the financing aspect. Okay. Right now, we'll discuss more about this statement and also based on certain ratios post a break. So let's take a break of around 10 minutes. Right, so 10 minutes a break, and then we can continue with the an exciting ratio called as capital gearing ratio. Can we say up to EBIT costing and no, not costing. Up to EBIT, you cannot say costing. Okay. Fictitious asset. Fictitious asset is basically those assets which are recorded in the balance sheet, but these are not assets. For example, preliminary expense not written off, advertisement expenditure deferred. So those are actually the things which should have been charged to P&L. I mean, they should have been debited to P&L, but they haven't been debited to P&L on a timely basis, and they have been just carried forward and being written off over a period of time. So till the time they are written off, they still remain in a balance sheet as a fictitious asset. Okay. So you can just take it down if you wish to, and then take a break. We'll meet after 15 minutes. You can take a screenshot, Sumit, during the break. Okay, sure. Let's take a break, guys. We continue. Are we all back, guys? So in income statement, what is deducted from profit after tax? It is preference dividend. After profit after tax, we are going to pay out the preference dividend. Okay, now let's discuss more about the long-term solvency ratios. Okay, we have already seen the equity ratio or propriety ratio, debt equity ratio, debt ratio. Now we have to go for something called as capital gearing ratio. Okay, capital gearing ratio. Let's understand what is this capital gearing with the help of the same example of question that we have done. Okay, now let us say these three companies, XYZ, are into the same line of business. And as far as operations are concerned, all three of them are same or equal. So we say the EBIT that is being generated by the three companies are same. So EBIT is basically going to be here 3 lakh, 3 lakh, and 3 lakh. So each of these companies are having a earnings before interest and tax of 3 lakh. Now, if I say borrowed funds are going to cost us, let's say 10%. Can you tell me what will be the amount of interest in each of these companies? What will be the amount of interest in each of these companies? Yeah, guys. What will be the amount of interest in each of these companies? At the rate of 10%, what will be the amount of interest? Interest is at the rate of 10%. So interest is obviously going to be a percentage of the loan that you have taken. Right? Interest is obviously going to be a percentage of loan that you have taken. So in case of X, the interest will be 0. In case of Y, interest will be 50,000. And in case of Z, interest will be 80,000. So you have profit before tax as 3 lakh, 2 lakh 50,000 and 2 lakh 20,000. Right? From this PBT, let us subtract taxes. Taxes at the rate of 30%. Right? So of 3 lakh, 30%, which is 90,000 is the tax. 2 lakh 50, 30%, which is amounting to 75,000 is the tax. And out of 2 lakh 20, we can say 66,000 is the amount of tax. So we have a profit after tax figure of 2 lakh 10,000. Then this is 1 lakh 75,000 and 1 lakh 54,000. Right. So EBIT less interest, we get PBT less taxes, we get PAT, which is 2 lakh 10, 1 lakh 75, and 1 lakh 54,000. Now, if I ask you out of these three companies, which one has performed better? Out of these three companies, which company has performed better? Can you tell me which company has performed better? Is it company X, Y, or Z? Which one has performed better? X. You're saying X because the profit after tax is higher, correct? You're saying X because your profit after tax is higher. Correct? But just think it that we are earning 2 lakh 10,000 on equity shareholders investment of 10 lakh. So if I ask you, give me the return on investment, or I'm talking of return on equity, return on investment or return on equity. Yeah, what will be the return on equity or return on investment? So return on investment is like whatever is the net profit for equity shareholders upon equity or upon owned funds. So on an investment of, can I say 10 lakh, on an investment of 10 lakh, company X is providing 2 lakh 10,000 as return to its investors. So what is the percentage return that the investor of, shareholders of X are getting? In percentage terms, what's the return on investment that they're getting? 21%. What about Y? What about Y? What about Y? What is the percentage rate of return that the equity shareholders are earning? For company Y, can you tell me what is the percentage rate of return? Can I say that's 175 on equity investment of 5 lakh? Okay, so that's 35%. What about Z? How much percentage? 77%, right? 1 lakh 54 on an investment of 2 lakh. 1 lakh 54 on an investment of 2 lakh, 77%. So if you look at the percentage wise numbers, which company has performed really well? 75.5. Is it? 1 lakh 54 divided by 2 lakh, 77%. Yeah. So which company has performed better? Can I say it's company Z which has performed better? Right? Now, I just want you guys to calculate this same number. I want you to calculate these same numbers, that is return on investment. If I take EBIT to be, let's say, let's say 90,000. So if your earnings before interest and tax is, let's say, 90,000, compute the return on investment for each of the three companies. So this was a scenario 1. Right? And now we are looking at a scenario 2. Right? So second scenario, EBIT is 90,000. Can you just compute the return on investment? Give me the return on investment numbers. Give me the numbers of return on investment if the EBIT is 90,000. If the EBIT is 90,000, give me the return on investment, guys. Return on investment or return on equity we are talking about. What's the return on equity? For the first one, it is 9%. What about the second one? You need to prepare the income statement, by the way, guys. Because remember, I'm giving you EBIT. So from this, you need to subtract interest. You get PBT. Less you subtract tax, and then you get PAT. To get the return on equity number. So for the first one, it is definitely 9%. What about the second and the third company? For the second company, what's the return on equity? For the second and third, it's not 9%. I'm asking you to prepare the entire income statement, guys. I'm asking you to prepare the entire income statement and then give the call. So interest, there is nothing over here. Here it is 90 and you're paying 27,000 as tax. So we have the profit after tax as 63,000. So here return on equity is going to be 63,000 on 10 lakh, which is 6.3%. Same way, get me the return on equity numbers for companies Y and Z. For company Y, there is a debt for which you're paying interest of 50,000, right? So we have the PBT of 40,000. From that 40,000, we can subtract the taxes also. So taxes would be at the rate of 30%, which is 12,000. And then profit after tax will be 28,000. So what's the return on equity? 5.6%. Because that's going to be 28,000 on an investment by equity shareholders of 5 lakh. So look for company Z. Give me the company Z ka number. What percentage is the return on equity? What percentage is return on equity? Yeah, so interest is definitely 80,000. You get a PBT of 10,000. You pay a tax of 3,000. Right? You're left with 7,000 of profit after tax. Right? So that should be like 3.5%. Right? So 3.5% is the return on equity. So what understanding can you have under the two situations? Is it always that company X is going to perform better? Is it always that company X is going to perform better? Or is it always that company Y or Z is always going to perform better? No, right? Because in the first situation, it was company Z which was performing better. In the second situation, it is the company X which is performing better. So company Z was performing better when at 77%. But when we turn to the second scenario, it was company X which is performing better. Right? Now, why is such situation happening? Why is the two different situations coming up? That answer lies simply on a number, what we call as return on capital employed. It depends on return on capital employed. Now, return on capital employed in scenario 1. Remember, all the three companies were having a EBIT of 3 lakh. Right? So business was actually providing us a EBIT of 3 lakh on an investment of how much? 10 lakh. Because the total money which was invested in the business, it was 10 lakh in all the three companies. So all the three companies had an investment value of 10 lakh. And on that 10 lakh, they were earning like 3 lakh. So scenario 1, what's the percentage rate of return that you're earning? 3 lakh out of 10 lakh. Can I say that is 30%? Right? So business was giving you a return of 30%. Business return was 30%. And was the rate, what was the rate of interest? The rate of interest was 10%. Right? So our business entity was getting funds at 10% and investing at 30%. Right? So the investor was getting funds, it was getting return at the rate of 30%, and on the funds that it has borrowed, it is paying 10%. So does it seem like a profitable situation? Does it seem like a profitable situation that you borrow at 10% and invest at 30%? Yes or no? You're getting money at 10% and you're investing at 30%. Of course, someone is giving you money at a cost of 10% and you're investing money at a rate of 30%. So there is this benefit of 20% that you get. And due to that, can I say the company which has borrowed money, we're actually generating larger amount of profit, which is 77%. But then this doesn't work always. Like in scenario 2, the return on capital employed was 90,000 on an investment of 10 lakh, which is 9%. Now just think of the business entity that it is paying out 10%, whereas it is earning 9%. So does it seem to be profitable area now? You get money at 10% rate and you're earning 9% on that money. Can I say you'll be losing money on that in that case? So in this situation, can I say borrowing is beneficial? And in this situation, we say borrowing is not beneficial, right? So when would taking debt help us in generating greater amount of profits? When would taking debt help us in generating greater amount of profit? Can I say when your return on capital employed is greater than the cost of capital or cost of equity, right? So we can definitely say borrowing is beneficial if return on equity, if return on capital employed is greater than rate of interest. So borrowing is beneficial if return on capital employed is greater than the rate of interest. And borrowing is definitely not at all beneficial if your return on capital employed is lesser than the rate of interest. If return on capital employed is lesser than the rate of interest, then borrowing is going to be harmful. As we can see over here, the company which has borrowed, it has generated lesser amount of return for its investors. Okay, right? So, is borrowing good or bad? Is borrowing money or taking money on a fixed cost, is it good or bad? Yeah, guys, tell me. What do you feel? Borrowing money, is it good or bad? Or both ways? So it is good. Borrowing money is good. Borrowing money is beneficial only if your rate of interest is lower. Only if your rate of interest is lower than the return on capital employed. Whereas borrowing is not beneficial if your rate of interest is going to be higher than the return on capital employed. Right? So we calculate a ratio. Now called as capital gearing ratio. Now capital gearing ratio is simply computed as funds requiring fixed rate of return upon funds not requiring fixed rate of return. Now, which are the funds that require fixed rate of return? Of course, borrowings, or we can say debt, plus preference share capital, upon which are the funds that do not require fixed rate of return. It's obviously equity share capital plus reserves minus fictitious assets. This capital gearing ratio is a measure of financing risk. It's a measure of financing risk, right? Now, from where did we get this word gearing? Achha, gearing has actually come from the word which we have in our automobile vehicles, which is by way of gears. How many of you know driving? How many of you know driving? Not the scooty ones, but the geared vehicles. Do you know how to drive geared, maybe a motorcycle or maybe a car? Yes? You know it? Okay, then tell me, if you want to start your car or you want to start your, let's say, the bike, um, in which gear does your car start? First, right? Can you start the car or vehicle directly in the fourth gear? No, it's not possible, right? So if you want to, increase the speed of your vehicle, do you need to increase the gear of the vehicle? Yes or no? Yes. So suppose if you're driving at the first gear and you want to attain a speed of maybe 80 kilometers per hour, is it possible? Is it possible for you to attain a speed of 80 kilometers per hour in the first gear? No. So there's always that limit. Once your car touches, maybe 10 to 15 kilometers per hour, you shift it to second gear, right? And then once it touches above 25 to 30, you go for the third gear. And above 40, 45, 50, you go for the fourth gear. And maybe at a higher speed, you go for an even higher gear. So just imagine a situation that if you want to attain that high degree of growth or high amount of speed, you need to put your vehicle into higher gear. You need to put your vehicle into higher gear. Am I right, guys? Am I right? You need to put your vehicle into higher gear. And if I want to have that high speed, I cannot be running my vehicle at a lower gear. Same fundamental over here. If you want to have a high degree of return on equity or return on investment, if you want to have a high degree of return on equity or return on investment, um, then if you want high rate of return, you need to have gearing. But that gearing is going to be beneficial only if you are able to maintain a high degree of EBIT. Now just think of a situation that you are driving your vehicle at a speed of 80 kilometers per hour. In which gear your vehicle would be? Maybe fourth gear. Now, while it is being run at, while it is being going at 80 kilometers per hour, you just press the clutch and then shift the gear to one. From fourth, you just shift it to one. What will happen? So you directly shift the gear from fourth to one when at a speed of 100, 80 kilometers per hour. What's going to happen? Can I say the car will come to a halt? The car will come to a halt. It will just stop immediately, and sudden stop will be there, sudden braking will be there, and the car will come to a halt. So if that is a situation, the idea is if you're maintaining that high growth, you need to maintain the high degree of gearing also. And if you want high gearing, you need to have that high degree of speed also. In finance also, it's the same thing. If you are ready to take that high gear, means take more of borrowed funds, take more of funds which require fixed rate of return, then you need to have a high return on investment is also possible. You cannot have high return on investment without going for high degree of gearing, right? And that gearing, that level of risk which you have is measured by the term capital gearing ratio. Very good, everyone? Yeah. So capital gearing ratio, it indicates the level of risk by which you are funding your business, right? So if you want to have the high level of gearing, it means if you want to borrow money or if you want to take funds which require fixed rate of return, then you should actually Okay. So going for higher rate of borrowing is going to require a greater degree of sales generation also, or return on capital employed generation also. Okay. So that's the capital gearing ratio. Now, just looking at capital gear, so in long-term ratio, long-term solvency ratio, what have we covered? Proprietary ratio, debt ratio, debt equity ratio, capital gearing ratio. Now, apart from just comparing these ratios, we would also like to know how capable a particular company is to pay the dues. So for that, let me just take an example of three individual persons. Let's say A, B, and C. We have information about salary of each one of them. Let's say X is having a salary of 1 lakh, Y is having a salary of 50,000, and B is having a salary of 50,000, and Z is having a salary of 60,000. The EMI that we have got is 20,000 for each one of them. Now tell me, what do you think? Which of these persons are more capable of paying the EMI? Which of these persons is more? Which of these persons is more capable of paying the EMI? Can I say A? Why do you say that it is E? Why do you say that it is A? So can I say, sir, how many times of EMI is salary? So here it is 5, 2.5, and 3, right? So this means for rupee 1 EMI, we have rupees 5 of salary. For 1 rupee EMI, we are having 5 rupee of salary. And then for B, we can say for rupee 1 EMI, we have 2.5 of salary. For rupees 1 EMI, we have 2.5 of salary. And the third one, the same thing for 1 rupee EMI, you have 3 rupees of salary. So of course, the more the salary is in proportion to the EMI or whatever your interest expense or principal due is, that is going to be more better. And for that, we are going to look at some of the ratios called as coverage ratios. Coverage ratios. So in coverage ratio, we have interest coverage ratio. So interest coverage ratio will be EBIT upon interest. So interest coverage ratio is EBIT upon interest, right, which is going to tell us how many times of interest is EBIT. Right. So it's like we are looking at how much interest is being covered by EBIT. So suppose EBIT is 400 and interest is 50, so you'll get answer as 8 times. So this simply means your EBIT is 8 times of the interest. EBIT is 8 times of the interest. Right. So EBIT is 8 times of the interest. Second is preference dividend coverage ratio. Preference dividend coverage ratio is going to be profit after tax upon preference dividend. Right. So this is going to again tell us how many times of preference dividend is your profit after tax, right? Or how capable you are to pay your preference dividend. Third is fixed charges coverage ratio. Third one is fixed charges coverage ratio. The fixed charges coverage ratio is EBIT plus depreciation, right? So EBIT plus depreciation upon, it is going to be interest plus principal. Interest plus principal due. So interest plus principal due is basically your EMI. So fixed charges coverage ratio is EBIT plus depreciation upon the EMI. So they are like how capable you are to pay your EMIs. Okay. One more, ratio which is more relevant is something called as debt service coverage ratio. So debt service coverage ratio. This is going to be calculated as earnings available for debt service, right? So earnings available for debt service divided by interest plus principal due. Now that interest plus principal due is nothing but the EMI which is due. Right? So earnings available for debt service. Now how do we compute this? So earnings which is available for debt service. What do you mean by earnings which is available for debt service? It means what is the income, what's the profit that you have to pay your debt. So here the calculation is a bit different. We start with profit after tax because tax is something which you have to pay irrespective of whether you have cash or not. So PAT, we start with PAT. Then we add back interest to it because we are seeing whether we have sufficient profits to pay interest. So since we have denominator interest, we need to add back the interest over here. Plus, we have non-cash items. When I say non-cash items, it's actually the depreciation that we are talking of, right? And then plus or minus, we adjust the non-operating items. So PAT plus interest plus non-cash items, PAT plus interest plus non-cash item, plus or minus any non-operating items. Okay, so non-operating items, PAT plus interest plus non-cash items, plus or minus any non-operating items. Right? So that's your debt service coverage ratio, which is going to tell us this is what you have to pay your debt. I mean, this is what the income that you have to make payment towards interest and principal. And you just take it in the numerator, denominator, you take it as interest and principal due. Okay. Fine. So these are some of the ratios that we have to check the eligibility of the company or, ability of the company to pay their fixed obligations. Right. So we're just looking at the ability of the companies to pay their obligations. These are the, again, into the categorization of liquidity ratios. We're still into the liquidity ratios where we have observed what is the short-term liquidity and also we have seen what is the long-term liquidity ratio. Okay. Now, let me just quickly recap and then I'll take up possibly queries from your end. So let's say we have three, the first ratio that we did was current ratio, which was current asset upon current liabilities. Then we improved it by removing the not so current ratio. Basically, illiquid assets were removed, wherein we removed the stock and prepaid expense from the numerator and we arrived at liquid ratio. So we made it even more stricter by applying the absolute liquid ratio, which is cash, bank, and short-term investments divided by the current liabilities. And then basic defense interval ratio is what we computed to identify what is the number of days of expense that we are having, number of days of cash that we have to bear the expenses. Beyond that, we also learned equity ratio, which is proportion of assets funded by equity. Debt ratio, which tells us the proportion of assets funded by debt. Debt equity ratio is going to tell us what's the ratio between debt, which is of borrowed funds, and the own funds. Then we stated that there is something called as capital gearing. In capital gearing, we said that higher the capital gearing ratio, greater is the risk, and also that poses as an additional opportunity for the company to grow at a faster rate. But to grow at a faster rate, you need to maintain a high gearing. And on the other hand, if you are having a high gearing, that is, you have a lot of debt and preference has to be paid, and if your EBIT drops, then there will be losses situation. Right? And then the return on capital employed. We said the return on capital employed can be computed by, borrowing was beneficial only if your return on capital employed is greater than the rate of interest and the other side. Capital gearing ratio is what we did. Then the coverage ratios is what we have covered. Interest coverage ratio, preference dividend coverage ratio, fixed charges coverage, and debt service coverage. So fixed charges, in the numerator we had EBIT plus interest, and in debt service we have like PAT. We add back to that the interest and the depreciation amortization, and also remove the non-operating items. Okay, so these are the set of ratios that we have done. We still have good number of ratios to cover in the next session, and then after that we'll go with the numericals on this. If we have any queries right now, we can definitely discuss it. Any queries, guys? Yes, Bhumika.
So our liquid ratio and cash ratio are same?
Liquid ratio and cash ratio, no. Absolute liquid and cash ratio are same.
But liquid ratio is stating that current assets minus stock and the prepaid assets. In that formula, current assets are only remaining up to that cash, bank, and short-term investments.
Receivables are also remaining, right? We have not subtracted the debtors balance from you.
Oh, receivables. And so when will you upload these notes in the website, ICAI BOS?
Just after our today's session.
So previous classes notes is not available.
It is available. I've uploaded it. Just check once again.
Okay, so thank you.
I've uploaded it, yeah. Yes, Pooja.
Sir, fixed charge coverage ratio and debt service ratio. What is the difference between them?
Difference is in fixed charge coverage ratio, you're looking at EBIT plus depreciation. So you're not bringing in taxation over here. You're not considering that you need to pay tax out of this also, right? But in case of debt service coverage ratio, we are taking PAT. So it means we are considering after payment of tax what is left out for payment of interest and the principal. Moreover, in fixed charges coverage ratio, we are not removing the non-operating item impact, because there may be some items which will be non-operating, which you would have, it may be income which has come for just once. It may be an expense which has been occurred just once, like profit on sale of asset or loss on sale of asset. So those all non-operating items are removed in the debt service coverage ratio. Debt service coverage ratio is a more accurate and sophisticated formula as compared to fixed charges.
Okay, sir.
Okay. Yes, Nagaratna.
Sir, I have one doubt. How to calculate borrowed funds, sir?
How to calculate borrowed funds?
Yes, sir.
Borrowed funds will be whatever loan you have taken. So all the form of debentures, bank loan, bank overdraft, all of that will be cumulated to borrowed funds.
Okay, sir. Thank you.
Okay. Capital gearing ratio. Capital gearing ratio is the ratio that we have already discussed, which is the funds which require fixed rate of return. Like which are the funds on which you need to pay a fixed rate of return? It is a debt and it is a preference share capital. And in the denominator, funds which do not require fixed rate of return is basically your equity share capital and all your equity funds or own funds. Right? So equity share capital plus reserves minus fictitious asset. Okay. Yep. Any other queries? Welcome, Sriji. Okay, so if there's no other queries, let's just call it a day. We'll meet up again in the next session, probably in the next week, so that then we can take the further ratios and then also the question numericals based on that. Okay, let's stop here, guys. Bye bye. Take care, guys. Good night.